There is a building in the city of London that has stood in various forms since 1694. It was not built for trade. It was not built for manufacture. It was built to hold a promise. That promise was simple in structure and revolutionary in consequence. The English crown would borrow from its subjects, and in return, the subjects would receive a permanent stream of interest backed by the future earnings of the state. No king had quite done this before. Rulers had borrowed from merchants, from the church, from foreign princes, but those were private arrangements, dependent on personal relationships and subject to repudiation. What emerged in 1694 was different in kind, not just in degree. It was debt institutionalized, debt formalized, debt made permanent by design. And once sovereign debt became a permanent institution, the entire logic of state power began to shift around it. Document scan, Bank of England original charter, 1694. Armies no longer depended solely on the metal in a king's treasury. Wars could be financed by selling future tax revenue today. Infrastructure could be built against projected growth. The state itself became a financial instrument, and the bond market became its operating mechanism. That is the structure this video examines. This is historical capital. Today, we examine how sovereign debt evolved from an emergency instrument into the foundational architecture of the modern state. To understand the significance of what emerged in the 17th century, it is necessary to understand what preceded it. Medieval monarchs were not without access to credit. Italian banking families, the Bardi and the Peruzzi of Florence most prominently, extended enormous loans to European rulers throughout the 13th and 14th centuries. And Edward III of England borrowed heavily from both houses to finance the early stages of the Hundred Years' War. When Edward defaulted in 1340, both banking families collapsed. The consequences reverberated through Florentine credit markets for a generation. This was the structural problem of pre-modern sovereign lending. There was no enforcement mechanism. A king who chose not to pay simply did not pay. The creditor had no institutional recourse. Reputation mattered, and repeated default would eventually close the credit window. But in the short term, rulers retained the option of repudiation. Lenders therefore priced in enormous risk, demanded collateral in the form of customs revenues or jewels, and kept loan terms short. Credit remained episodic, expensive, and politically fragile. The result was a fundamental constraint on state capacity. Wars were limited by the gold and silver physically available. Campaigns ended not when strategic objectives were met, but when the treasury ran dry. Even the wealthiest monarchies faced hard fiscal ceilings. The structural breakthrough did not originate in London. It originated in Amsterdam. The Dutch Republic, fighting for independence from Spanish rule in the late 16th and early 17th centuries, developed a method of war finance that was structurally distinct from anything that had come before. Rather than borrowing from wealthy individuals under private arrangements, the Republic sold bonds to its own citizens, broadly distributed across the merchant and professional classes of Amsterdam and other cities. The mechanism was elegant. Citizens purchased bonds issued by the provincial estates. Those bonds paid regular interest, backed by excise, taxes, and trade revenues. Crucially, the bonds were transferable, and they could be bought and sold between investors. This meant that a bond was not simply a claim against the state, it was a negotiable financial instrument with its own market value. This transferability changed the calculus of sovereign lending fundamentally. A lender who committed funds to a 10-year bond was no longer locked into that position for 10 years. If liquidity was needed, the bond could be sold. This reduced the personal risk of lending, which reduced the interest rate the Republic had to pay, which reduced the cost of war finance, which extended the state's strategic capacity. Spain, despite commanding the silver output of the Americas, paid far higher borrowing costs than the Dutch Republic, because the structural quality of Dutch sovereign credit was superior. The Dutch could access capital more cheaply, and that capital efficiency was a decisive military and strategic advantage. The lesson was observed carefully across Europe. England absorbed the Dutch lesson and formalized it. In 1694, the newly established Bank of England was granted a charter to lend £1.2 million to the Crown at 8% interest. In exchange, it received the right to issue bank notes and operate as a joint stock bank. The debt was perpetual in structure. The Crown was not obligated to repay the principal at a fixed date. Only the interest mattered. This was not an emergency measure. It was a deliberate institutional design. The separation of debt issuance from direct borrowing was critical. The state no longer negotiated with individual lenders. It issued instruments through an institutional mechanism, the bank, which then placed those instruments with investors across a developing market. The political exposure of default became structurally different. Repudiating a bond was no longer an offense against a single powerful banker. It was an offense against thousands of creditors, including, increasingly, the class of merchants and investors whose political influence was growing rapidly. This created an alignment of interest between the state's creditors and the state's fiscal discipline. Investors who held government bonds had a direct financial stake in the state's ability to service its debt. They became institutional advocates for sound fiscal management, for tax collection, for reliable accounting. The Glorious Revolution of 1688 had constrained royal authority and expanded parliamentary control over revenue. Parliamentary control made spending commitments more credible. More credible commitments lowered the interest rate required. Lower interest rates expanded the sustainable debt level. The structural feedback was reinforcing. Democratic accountability made debt cheaper. Cheaper debt made state expansion more feasible. Feasible expansion funded the naval and military power that underpinned commercial empire. The structural spread from London to the modern world. The architecture was widely understood and widely replicated. France, despite its larger population and territory, struggled with precisely the opposite dynamic through much of the 18th century. The French crown borrowed through privileged intermediaries, tax farmers, and court financiers whose credit quality was entangled with royal favor rather than institutional discipline. Interest rates for French sovereign debt were consistently higher than English equivalents throughout the period. The fiscal cost was significant. The war-making capacity difference it produced was consequential. By the 19th century, the bond market had become the central institution of international finance. The Rothschild family and its network extended the market across Europe to a facilitating government borrowing in London, Paris, Frankfurt, Vienna, and beyond. Sovereign bonds were not simply national instruments, they were international commodities rated by reputation, priced by perception, traded by institutions whose interests transcended national borders. This internationalization of sovereign debt markets introduced a new form of discipline and a new form of vulnerability simultaneously. The discipline was clear. A government that mismanaged its finances would find its bonds trading at a discount. The cost of new issuance would rise. Eventually, access to credit markets could close entirely, as happened to the Greek state repeatedly throughout the 19th century, and as would happen to many emerging market governments in subsequent centuries. But the vulnerability was equally structural. States that had integrated themselves into international capital markets were now exposed to the sentiment of those markets. A loss of confidence could trigger a crisis of rollover, the moment when maturing debt could not be replaced on acceptable terms. The state had traded fiscal flexibility for lower ongoing borrowing costs, but in doing so, it had accepted a form of external constraint that medieval monarchs had never faced. The Bretton Woods agreements of 1944 formalized sovereign debt at the international institutional level in ways that went beyond anything the 19th century had constructed. The International Monetary Fund was established to provide a short-term balance of payments support to member governments. The World Bank was established to provide long-term development finance. Both institutions operated through the mechanism of sovereign lending, and extending credit to governments on terms structured to influence policy behavior. Debt was no longer merely a tool states used to fund their operations. It had become an instrument through which international institutions shaped domestic economic governance. Simultaneously, within the advanced economies, the nature of sovereign debt changed structurally. The post-war expansion of the welfare state required sustained financing. Tax revenues were supplemented by bond issuance, not as an emergency measure, but as a routine element of fiscal management. The debt was rolled continuously, maturing obligations replaced by new issuance rather than repaid. Repayment of principal became, in structural terms, an aspiration rather than an expectation. By the 1980s and 1990s, sovereign debt markets were the largest financial markets on the planet. The United States Treasury market alone underpinned the global reserve currency system. Treasury bonds were not simply instruments through which the American government borrowed. They were the foundational collateral of international finance, held by central banks, institutional investors, and foreign governments across the world as the safest available store of value. A paradox had emerged at the center of the system. The most systemically important financial instrument was a debt obligation of a government that had no plan to repay its principal. The market's confidence in that debt did not depend on repayment. It depended on the perception that interest would be serviced reliably and that rollover capacity would remain intact. The debt was permanent by design, and the system had been constructed to function on that basis. What the architecture of sovereign debt created over 3 centuries was a system in which the state's fiscal capacity was no longer limited by the metal in its treasury or the personal relationships of its monarch. It was limited instead by the confidence of capital markets in the state's institutional quality, its governance, its long-term revenue capacity. States with credible institutions, clear legal frameworks, and consistent fiscal management could access essentially unlimited capital at low cost. States that failed to maintain institutional credibility faced dramatically higher borrowing costs, external intervention, or outright exclusion from markets. This created a powerful structural incentive for institutional development. Parliamentary control of revenue, independent central banks, transparent fiscal accounting, credible commitment mechanisms, these were not merely political values. They were the institutional infrastructure that determined the price at which a state could access capital. The financial system rewarded institutional quality, and over time, that reward shaped the institutional evolution of the state itself. The relationship between sovereign debt and institutional development was not merely correlational, it was structural. A government that could borrow cheaply, could invest in infrastructure, in education, in military capacity, in long-term strategic positioning. The compound advantage over time was substantial. The architecture of debt was, in a fundamental sense, the architecture of modern state power. The logic established in 1694 remains the operating framework of global sovereign finance today. Central banks hold sovereign bonds as reserve assets. Institutional investors hold them as stable collateral. Pension funds depend on their yield. The rollover mechanism continues without interruption in the advanced economies, not because investors believe they will be repaid in any final sense, but because they believe the institutional architecture will sustain the flow of interest indefinitely. The stress points of the contemporary system are visible in the same structural terms the Dutch innovators and English architects would have recognized: credibility of the fiscal framework, stability of the institutional environment, depth and liquidity of the secondary market, the confidence that rollover capacity will remain intact under adverse conditions. When those structural conditions are questioned, as they were for peripheral European sovereigns in 2010, the mechanism functions as it always has. Spreads widen, borrowing costs rise, external intervention is sought, the discipline of the capital market reasserts itself. The system has not fundamentally changed since the Bank of England first formalized the architecture. What has changed is scale, complexity, and global integration. Sovereign debt was not invented by accident. It was engineered iteratively across several centuries by states seeking to overcome the fiscal constraints imposed by the physical limits of metallic money and the political limits of private lending. The Dutch understood it that broadly distributed, then transferable credit was cheaper than concentrated private lending. The English understood that institutional discipline credibly backed by parliamentary constraint was cheaper still. The 19th century bond markets understood that international capital integration extended that logic across sovereign borders. Each step in this structural evolution expanded the fiscal capacity of states that adopted the architecture. Each step also introduced new forms of constraint and new forms of vulnerability. The architecture is not neutral. It rewards institutional quality. It punishes instability. It embeds creditors with structural influence over sovereign policy, and it operates on the foundational assumption that sovereign debt is never retired, only managed. That assumption holds when institutional credibility holds. When it does not, the mechanism operates in the same direction it always has. And history follows the capital.
If you're interested in how power actually works beneath the surface, subscribe, support the channel with a like, and let me know below which historical pattern you want explored next.